Hey guys, I hope you guys are doing good today. You bought Petronet LNG hoping it would hold at 300 rupees. It didn't. It hit at 235 rupees. And right now, it is sitting at 282 rupees. It is actually a down at 26% from its August 2024 high of 383 rupees. So here is the real question. Is this a fire sale on a great business, or is that something fundamentally broken? That's something like market is trying to tell you. So today we go through entire company. We will talk about the business model, cash flow, promoter integrity, debt, and the other one is like the profit manipulation check. And finally, I will give my honest opinion about this particular stock. So please do watch this video fully. Without wasting time, we can quickly get into the video. Before that, if you are new to my channel, please do subscribe it. Let's go. Let's talk about the business model. First, what does Petronet LNG actually do? Most people think this is an oil and gas trading company, but actually it is not. Petronet is an infrastructure company. It operates India's LNG imports terminal, Dahej in Gujarat and the Kochi in Kerala. The combined regasification capacity is 22.5 MMTPA. That is 43% of India's LNG regasification capacity. It is only one company. Here is how the money actually works. Petronet doesn't own LNG. It charges the toll to process it. GAIL, IOCL, BPCL, they signed long-term contract and pay Petronet per unit of gas processed. The key mechanism is called use or pay contracts. Even if the customer doesn't use the terminal, still they have to pay. This is the moat for the company. That is why the company has printed the profits every single year for the past decades without fail. On top of that, Petronet buys LNG on long-term contracts from Qatar LNG and sell it as regasified LNG to their customers. A revenue is largely a commodity pass-through. When global LNG price falls, obviously the revenue falls. But the toll fee, it stayed fixed. That is why the profit grew even as a revenue fall. Check out this particular slide. Even someone is telling like Petronet revenue is falling. Here, the lower revenue means lower LNG price globally. There is nothing more to talk about that. Let's talk about the financial health. Let me take you through three important things that matters you most. We will talk about the profit, cash flow and debt. Let's start with the profit. In financial year of 25, the net profit is 3,973 crores. It is actually 8.8% up from last year. Look at the 10-year profit journey from 928 crores in financial year of 16 to nearly 4,000 crores today. That is actually 4x growth in under a decade. Their operating profit margin is expanding from 9.87% in financial year of 24 to 10.84% in financial year of 25. So the margin goes up when the revenue goes down. This is the sign of the quality business. Let's talk about the cash flow. This is something my non-negotiable filter. Here, the operating cash flow, it seems to be positive. Investing cash flow, it is in negative, and the financing cash flow, that is seems to be a flexible. This is something passing every year. In financial year of 25, the operating cash flow, that is 4,398 crores. That is more than reported net profit. When operating cash flow exceeded the reported net profit, you obviously know that is something real. The company is not manufacturing the profits on paper. Cash is actually landing on their bank. When you look at the investing cash flow, that is negative. I mean minus 3,189 crores. That spike is Dahej terminal expansion from 17.5 to 22.5 MMTPA. This is something an productive capital expenditure, and I feel this is something a green flag, not a red flag. When you look at the cash balance, they have 9,104 crores. They started the decade with 863 crores. Today, it is 9,104 crores. That is something 11x increase in cash pile. Let's talk about the debt. Here, the borrowing, it got peaked from 3,690 crores in financial year of 20. What about today? It is 2,657 crores, and that is something falling every year. Here is the number that matters most. Their cash is something like 9,104 crores. That is something 3.4 times of the total debt, which is like 2,657 crores. What I understand is Petronet is effectively a debt-free company. They could repay every rupee of debt today and still they do have 6,000 crores sitting on their bank. So let's talk about the promoter check. Who owns this particular company? There are 4 PSU Maharatnas. They are GAIL, ONGC, IOCL and BPCL. Each of them are holding 12.5%. So the total gas utility at international, that is something like 5.2% stake that is linked to the French Total Energies. FII, they owns 14.3% and rest of them think it is owned by retail and the mutual funds. Mutual funds in the sense like DII. So what does this mean for you as an investor? First is the promoter pledge. It is zero, not a single share pledge. That is something and most important thing. I see it is a green flag here. Number 2, it's a governance. These 4 PSUs are CAG audited. They are completely ministry supervised entities. The risk of the promoter is siphoning money through the related party transaction is near to zero. Third one is no insider selling alerts in recent filing. Most of the PSUs, they don't buy in the open market. That is just how the government owned promoters work. I feel this is something normal. There is one honest flag from my side, that is like PSU bureaucracy means the slow decision making. That is a best example like their Dahej expansion. It took a lot of time. That is a trade-off with PSU backing stocks. Let's talk about the profit manipulation. This is something the most important. The retail investor should not skip it. Their profit is real or it is something they are manipulating. Let's check. The check number 1 is their operating cash flow versus the net profit. In financial year of 25, their operating cash flow is 4,398 crores. That is greater than their net profit is 3,973 crores. When the cash flow is getting exceeded the reported profit, what we can understand is profit is something not manufactured. Let's do the check number 2, the revenue source. The revenue fell because the commodity price fell. It is because not the customer left. The volumes have actually increased. Dahej handled its highest ever ship count in June 2024. So the revenue drop is a price effect, not a volume effect. Check number 3, it's a tax rate. It is actually a consistent 25 to 26 effective tax rate on every year. The companies manipulating the profit often shows the sudden drop in the tax rate to artificially boost the profit after tax. I don't see any kind of patterns here. Check number 4. It is dividend. It is actually 10 rupees per share. This is something like consistent for 3 straight years. Their payout ratio is 38%. A company that pays a real dividend from real profits. This is not a promoter cash out scheme. They look at their other income. It is rising from 306 crores to 772 crores. That is in just 5 years. Most of this is interest earned from 9,000 crores from the cash pile. That is something legitimate. Just monitor the mix. What I understand from these checks and these points, the company seems to be clean here. Oh, this is very important. Why did the stock fell? Obviously, the company is clean, the profit is growing. Why did the stock, it got crashed up to 26%? There are 3 reasons that you need to know. The one is completely noise. The other one is legitimate re-rating. The third one is something like it's a real risk you should need to know before you are investing. Reason number 1, the narrative confusion. The revenue, it fell from 59,899 crores to 50,982 crores. That is something like over 2 years. Most of the retail investor, they see it's a revenue fall and they started selling it. I've already showed you that fall is global LNG price fall. Their underlying business, it's got stronger. What I understand is it is completely a pure noise. Reason number 2, the valuation correction. In 2023, the stock, it was trading around 180 rupees. It ran up to 383 rupees in August 2024. That is something like 113% of the rally. At 383 rupees, the stock PE, it was trading around literally 15 to 16 in range. That is not a cheap for slow growth infrastructure PSU based company. Some correction from that level, it seems to be healthy and obviously it is expected to correct. Reason number 3, this is the very important, it's a real risk. I mean, there is a lot of geopolitical issues which comes around here. In March 2026, the things it got serious. The Qatar LNG declared the force majeure attack attack on Ras Laffan complex in Qatar. Ras Laffan is a single loading port that supplies most of the India's LNG. The Strait of Hormuz is the shipping route and it is obviously unsafe. So the Petronet's 3 LNG tankers like Disha, Rahi, Asim, the company issued the forced measure notice to BPCL, GAIL, IOCL. The Qatar Energy flagged the infrastructure repair could take 3 to 5 years. India, it imports the LNG from Qatar and UAE, which is like something 55%. This is not a small issue. That is the main reason the stock it fell 22% in single month after getting these news. But the timing risk is a real risk. During the disruption, obviously the cash flow gets squeezed. That is why I am saying wait for the clarity before deploying a serious capital on this stock. So let's talk about the valuation. So what is Petronet's worth? The PE at 282 rupees, which is approximately 10.5 times. The oil and gas sector average is 16.16 times. The peer average of comparable infrastructure company is, that is something like 45 times plus. On PE alone, Petronet is at 35% discount to its sector. EV and EBITDA, which is approximately 6.3 times for an infrastructure company with 24% of the ROCE, 43% of the India regasification capacity, use or pay contracts, and the zero near debt, which is 11.3x, it is historically cheap. The dividend yield for this particular company is 3.7%. In a market where the index yield is 1.5%, I feel like this is a meaningful income cushion. Being as a value investor, 20% upside on a business with a live geopolitical overhang, I feel there is no margin of safety. Okay, here is my opinion about this stock. When you look at from the business model, this is excellent. It is completely an infrastructure moat. This is an toll-based model. Obviously, PSU is backing. Let's talk about on cash flow. Their operating cash flow, it is in positive over a decade. They have 9,000 crore of cash in pile. When you look at the debt, which is effectively zero, and it is being reduced every year, the profits are real. Obviously, it is growing and it is not something manipulated. Operating cash flow, it is exceeding the reported net profit. The promoter pledge is zero. It is completely backed by 4 PSUs. The governance risk is low. When you look at the valuation, this is not that cheap when we are having with these geopolitical issues. So these are all the good things about the company. Let's talk about the risk. The Qatar force majeure and the Strait of Hormuz disruptions. This is actually a timing and the volume risk, not something in business quality risk. The company itself, it is fundamentally unchanged. Okay, I am not going to buy this stock as of now. Currently, it is trading around 277 rupees. If it touches nearly 240 or it touches nearly 245, I will think about in SIP mode or something like that. If it goes below 220, then that is a great opportunity on the investing. I hope you might have liked this video. If you like it, please do hit like button and please do comment. I'm happy to read all your comments. We'll see you on another good video. Please do subscribe it. Thank you so much. Bye-bye. Happy weekend.